Get over to Rick Santelli at the CME for more on the significance of today's moves here in the bond market, Rick.
Yeah, you know, the data was pretty much weaker than expected, but let's start at the beginning. So we see ADP at 37,000 at 8:15 Eastern, lowest since March of 23. But as you look at that chart, you know, we've been down before. We had a 42,000 read. So it's not as though that chart looks like it's falling apart, but there's definitely deterioration. Now, let's look at the second group of data points. We had service sector ISMs, and S&P Global was first, and they came in with 53.7, which was better than expected, second highest reading of the year. However, it was a split decision because the ISM, what you're looking at now, was the weakest going back to June of 24, under 50 at 49.9. So split on the service sector, PMIs, weaker jobs. Well, let's look at what the market said about it. Here's a 12-hour chart of two-year note yields. And boy, you could clearly see the two cliff drop-offs at 8:15 on the jobs, and then again at top of the hour 10 as you see the weaker than expected ISM PMIs. Both of those are very clear. And we also had a much hotter than expected prices paid that was completely overlooked. And that's a good clue about what the Treasury market seems to be paying attention to. And you pointed it out, lower rates are maybe fueling the fire for a greener equity market. But at some point, those two have to reconcile each other. And finally, 2-year and 10-year both on pace for the lowest yield close since the 7th of last month.